private equity secondaries market enables the buying and selling of positions in private equity investments. The strategy solves the liquidity challenge in private equity. It helps existing investors exit early from their fund commitments and enables fund managers to offer liquidity to their investors. Secondaries started as a niche strategy in the 1980s. Coller Capital has been there since the early days, and today we are a market leader and 100% focused on investing in secondaries.
In private equity, there's something called the J-curve, which is the shape that a line makes on a graph plotting the typical performance of a fund over time. You can visualize it like a hockey stick. At the start, there's a bend in the stick, a dip. This reflects the first few years when returns are usually negative because of investment cost and management fees. While the assets go through a period of transition and typically growth, the stick will tend to straighten and move upwards as returns improve. In secondaries, since you're coming in after the primary equity buyer, you're entering later in the investment cycle. This means potentially mitigating some of the J-curve dip. Buying more mature assets at a later stage means you also have greater visibility into the investments, reducing something that we call blind pool risk.
Secondaries funds generally buy portfolios of fund positions, so they purchase a larger number of assets than most primary private equity funds. Therefore, secondaries portfolios will typically be more diversified across managers, geographies, industries, and vintage years. We believe this can offer investors a wide range of exposure across private market asset classes and a diversification profile with potentially attractive risk-adjusted returns.
Primary private equity investments usually have a longer holding period, typically 10+ years. Buying stakes in more seasoned assets via secondary funds can potentially shorten the investment horizon, meaning quicker distributions for you, the investor.
We believe another key benefit of secondaries is that limited partners sometimes choose to divest their portfolios at a discount to make the sale more attractive to buyers to generate liquidity. As the secondary market has matured over the last 30 years, the number of stakes in blue-chip private assets available in the marketplace has also grown. This means that secondary fund managers can potentially get favorable pricing on high-quality assets, which translates into greater potential return for investors.
We feel that buying assets at a discount, diversification, the faster return of capital, and the compelling risk-return profile makes secondaries an attractive strategy for individual investors, especially those considering alternatives for their portfolios.